Why aren't we just yet in a bond bear market? Still.
Yeah, no, it's because we're not quite seeing what we need to see out of inflation. And so, if you notice what the Bank of Japan did, which wasn't a surprise, but they're keeping money easy. The ECB will likely too. At the Fed, they're on a slow tightening move. But even though growth is good, inflation is yet to be seen. And we'll probably see more evidence that it's not here next week when we get the core PCE number, which is what the Fed watches. So we're not quite there yet.
Well, we just heard Ken Rogoff in Davos telling Tom Keene that inflation is going to hit 2% this year, and it could come on us all of a sudden. We also had Marvin Goodfriend before the Senate Banking Committee today saying that he thinks that QE3 should never have happened, and he's worried. He thinks the Fed will raise more than possibly the market.
Right.
What are the prospects for you of that? I mean, what kind of odds do you put on that happening?
So this would be what the fourth forecast of the first inflation. What we see, we're definitely going to see more inflation this year. I mean, you can't raise minimum wages or even raise wages and give bonuses and not see inflation. But I see it more as a second half of the year event versus between now and the first half of the year. So pressure on rates is not likely going to come until after June or July when this full effect is in the marketplace. But right now we have seen some pickup in wages, but we haven't seen a pickup in what the measure that the Fed looks at in inflation. And until that happens, that can go from 1.5% where it is now to 2% before you actually sound the alarm bells that rates need to go higher. And so I think it's a later in the year event versus now.
So which is bigger for you, the risk that inflation will beat or will miss estimates? Well,
the greatest risk is that you show up too late. And that it does come on you, as you talk about, a lot faster than you think it will. What we need is a gradual increase in inflation along with maintaining the growth rate. If we get spikes in inflation or in growth, then we're in danger to go from a 260 to a 290 pretty quickly.
Where do you see rates going?
My forecast is still around 2 3/4 for the 10-year in particular. Obviously, the Fed's going to control short-term rates, and we may see 2.5, which would be an oddity towards flattening that we've been preparing for, but probably doesn't tell us that we're about to see a recession. So 2 3/4, 280 maybe, but it's going to depend on how that second half of the year inflation comes about.
January 31st will be Chair Yellen's last meeting. When are we expecting the first rate hike?
Well, if you look at the probability index, that would take you to almost 90% for March 21st, which is the meeting after the January 31st meeting. My guess is, and my prediction is only 2 this year, so we wouldn't see that until the following meeting, probably like May.
So you see a tight range again this year, maybe between 2.5 and 2 3/4.
Right.
Will it be more volatile?
Most definitely. If you look at the MOVE index, even right now, we have come off of the bottoms of about 45 to about 55. So volatility is up, and it's been up almost since the end of the year, and likely will be all year long. If you remember, so last year we went 245, then we went to 260, then we went down, and then back up again. But most of that upper move on rates was done by March in 16, July by 17, and we're in that cycle right now. But I think this time it is going to be different, and that there's a gradual push up towards rates higher.